All right. Good morning, everybody. Good morning. Good morning. It's your boy Sherm. So, as we went over in last night's NA meeting, the market did exactly what I expected it to do. And this is why we don't trade in the middle. This is why we don't. On the NQ, we talked about this possibly in an area, or where was it at? Was it this one? No, it was this area right here. This area being a potential area where the bulls to come back in, and they did take price higher. However, we did get this drop right back into this range. So we definitely got a drop right back into this range. Hmm. Okay. So price is back into this range. Now, I wouldn't be surprised if the bulls make an attempt to actually try to buy here, actually. I really wouldn't be surprised. I mean, the market is still not getting that rotation down. The bulls are preventing the market to rotate downward. We do have Crash Kari coming up in the next 20 minutes. However, I mean, unless he says something crucial, crazy, I think we're going to get this possibly until tomorrow. I mean, the market can definitely chop until tomorrow, but we'll see. We'll make sure that we take every trading opportunity that presents itself. I will say that the ES has been holding up this range. The bulls have been holding up this range. We did get that initial pump, like we talked about. It got to that 39 level, and we got this big drop down. So if he was in short at 39, you got your 10 points right here at 29. And so, yeah, this was about like a 14-point play from top to bottom from that 39. And I think the bottom was actually 24. So, yeah, you got your 15 to 14-point play here at this drop. And I'm thinking that we possibly can see another drop back into this range, probably at this 18 level where there was prior support here at this 18 level. Yeah. Hmm. Yeah, possibly 18, 16. I mean, I guess I really wouldn't. Yeah, from 18, 16, we can possibly get. Hmm. 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 Yeah. Uh, I guess we're just gonna have to see what happens. The bulls are definitely holding it off. They are not allowing price to rotate lower at all. Good morning, Tommy. Good morning. They're not allowing it to rotate at all. So, um, what's up, Katie? Hmm. I guess let's see what happens. So if price gets down here to this 18 level, 18, 16. If we get back into this area, I'll consider taking this long. If we can get back into this area right here. The risk reward is not great, but at the same time, we kind of have to adapt to what the market's doing. The market is trying to maintain its bullishness to carry on the narrative that the economy is still strong and resilient. And that word resilient, I think that's the word that we should focus on, because being resilient means that it's holding up even though it's under an extreme amount of pressure. That what makes this market resilient. And the bulls are just not letting this go. So I can see this kind of looks like I think this was a rising wedge. If you can see, it looks like it. We may get a drop, but I'm pretty sure that the bulls are going to buy this right back up here at this 18 to 16 level. I wouldn't be surprised, honestly. And I guess the most we can do is try. I mean, we can try. We can try here at 18. If we see the bulls coming in, we can try. And we can even lessen our stop down to 5 points. Yeah, probably. Yeah, probably just don't do that again. Yeah, let's see. All right, so we got this big drop down at 39. Honestly, I kind of wish that I actually took this trade at 39, but honestly, I didn't trust it. I didn't trust this trade at 39, but obviously in hindsight, I should have took it. Obviously in hindsight, I should have took it. I don't think they go for this 12. I think they probably go for 16. They probably go for 18, 16. We'll probably see like a bounce. Like if price gets down to this 18, 16 level, we can definitely see a bounce here. Yeah, yeah, okay. That's what we can do. That's what we can do that. And then once we get that bounce, then yeah, I would definitely agree. We can see that move up to test all-time highs because I don't. Okay. Oh yeah, I got this. Okay. I was like, why is it doing that? Oh crap. I'm tripping. I'm tripping. It's like, why I'm tripping. I was like, what the hell am I missing right now? I'm tripping. Uh, thank God I did that. Okay, I was like, what the hell am I missing? Take strike. Mm. Okay, so we got the tick strike going on. Um, so we don't have any news, but we do have Crash Kari coming up in the next 15 minutes. We do have our boy Crash Kari. So market on open. So according to this, I don't know what the moo is, or I mean not the moo. Well, never mind. Never mind. I take that back. I'm trying to make sure I'm reading this correctly or understanding this correctly. So it says market on open got 15 million, 179 million, and then positive 163. But obviously you have more buying on the NQ than the ES. And obviously you have more selling on the Dow than buying. So it's about 50. So I'm thinking this is about probably like 60-40 right here. And this is 60-40, and this is obviously about like 70-30, just roughly speaking. Yeah, so you got 26 million to the sell side, you got 6 million to the buy side, and you got 43 million to the sell side. And the Magnificent Seven, you got 1 million to the buy side. So I'm up. I'm pretty sure it. Yeah, I'm pretty sure. Well, no, the NQ ain't doing nothing. It's sticking there. But yeah, I'm guessing. Yeah, everybody's just waiting for Crash Kari. I guess they're just waiting for him, and hopefully they got him. Mm, I hate when they do that. Okay. All right. So this is no. This is at 2 o'clock. Damn it. This is at 2 o'clock. Uh. Yeah. This is at 2 o'clock. So I don't think we're going to be able to actually listen in to what he says unless we can find it somewhere. But it's not available. So Crash Kari speaks. Um, let's see if we can find it. It's something at 2 o'clock, but what I'm referring to is at 8:55 right here. We got 8:55. We got him speaking, but there is an event where he speaks at 2 o'clock. But by that time, the market's is like that's 30 minutes into the close, so that doesn't even matter. Yeah, yeah, 2 o'clock at that time frame doesn't even matter. Hmm. So let's see. Nice. All right, so we're getting a continuation on that drop. All right, so that's gonna be at one. Hmm. Yeah, I guess they're not gonna broadcast what the hell he has to say, which is unfortunate, really. It's unfortunate. And man, I should have took that short at 39. I should have took that short at 39. Should have took it. It goes to shows that it really goes to show that you trust your charts even though your heart tells you that the charts are wrong. And the reason why I was just mm, so doubtful about that 39 level is because we had a higher level above it, and I figured that the bulls were going to want to try to test that level. But we are getting close to this 18 level. I want to see if the I want to see if the bears actually I want to see what happens if the bears push into this level. But if I see bullishness, then I'll take it. And I'll just reduce my risk on this one. So I'm actually just going to put a buy limit here at 18. And then I'm going to put another one here. Hmm, 16. And I'll just put another one down here at the bottom of this range. We'll see what happens. Yo, congratulations on that, Jack. I wish I was in this with you. I really would like to, especially when we talked about this last night. I would really want to be in this move because this move down was this, what is this, like a almost a 20-point move. And this would have been the trade of the day. The trade of the day right here. So it would have been nice to be in this move. All right, so we got this move down. Yeah, I think that'll probably be like a better. All right, so we got that move down. Hmm. Hmm. All right, so let's look at the NQ real quick. Let's look at her. Oh, this is the ES again. I hate that it does this. Hmm. This is why we don't trade in the middle. This is why we do not trade in the middle. Because we talked about this last night. I mean, if you took this, where was it at? If you took it long, I mean, it worked, but there's always a possibility of this happening right here. Yeah, I think, yeah, was it like, where was it at yesterday? It was at one of these. Anyway, I would have to see the bulls hold this back up. I would have to see it, but the way that the market is sloped down, this could possibly be the, let's see. Let's see. Let's see what happens at 8:23. About 794, 795. Yeah, possibly at this 800 level, 790. Yeah, we'll see. I'm gonna give, I want to see what happens when price trades into this range right here. But man, it touched that 980 level to the, well, I was looking around 985. It only got to about 981. So I would have been off by 4 points on this if I set a limit on this. Would have been off by 4 points. We got that big drop from this level. Yeah, I kind of felt that it wasn't going to take out this high, not yet. But the day is still young. We still have time. It does look like the bulls does want to recover right here. And we do have a triple bottom right here now. And in terms of risk reward, having a stop right, having, well, if you got in at this area, having a stop a couple of points underneath these candles for a retest of higher structure would have been definitely a good risk reward trade. But I'm thinking if the Bears don't hold it up, I'm sorry, if the Bulls don't hold it up at this 820 level, and then we can definitely see 790 because that's the next level down. 790. And I would actually consider a trade at 760. If price gets down here, I would actually consider taking this. because I know if we get down here to 760, that recovery will be massive. That actually might be a 100-point play in all reality. All right, our boy Crash Kari is at the podium saying whatever he's saying in secret because he's not allowing the market to hear what the hell he has to say, which sucks. 16. He says normally somehow. Especially after a massive run, especially if we run on Fridays. Uh, yeah, I think I'll do that. Mm, 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 oh, come. Mm, 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 mm. All right, tap me in.
Order filled.
Okay, the first order is filled. The first order is filled. Okay, so the FOMO's gone. I'm in it. Now, if I can get the second order filled, then that would be also awesome. Um, okay. All right, so I'm gonna put this right here. And I don't know what's going on with that. Yeah, I think that's good. That's good. And we got the algo coming up in the next 30 seconds. So let's see what the algo chooses to do. He said Bill Walton. Who's that? Let me see what that is. Oh, okay. It looks like he's lived a good life. Unfortunately, he lost his battle with cancer, but it looks like this man has lived a great life. He has a lot of accomplishments. It appears that he was a former basketball player turned broadcaster. You know, he's a NBA Hall of Famer. So it looks like, yeah, he had a good life, man. He had a good life. Yeah. I do see that with a lot of basketball coaches, especially the ones where, I mean, honestly, you kind of have to. I mean, in order to be a great coach, you have to have genuine passion for people, a genuine passion for people in order to be a great coach because people are difficult. And we all know this. People are difficult. And to deal with people as your career or dealing with people being a big part of your career, if you don't have a genuine love for people, that should kill you. And because every day, day in and day out, you have to deal with people. All right, so I think that we can get our first target hit on this one before we see any retracements. I mean, if I see any craziness before we get to that first target, we can take it at 9 points. It's not a big deal. It's just 1 point off. Um, but I do believe that with this, we can definitely see price go into that higher time frame because we did talk about this last night about potentially the Bears taking price down from 39. And again, I kind of hate that I didn't take this trade because man, it hit 39 perfectly. It hit 39 freaking perfectly, man. And that was a 23-point trade. And see, like I said, even I'm not immune to inversing. If I inverse myself, if I overthink things, I find out too, because the charts are always right. Would maybe not take that trade to the short side was my heart. I was like, man, I don't want to get caught. I mean, there's higher areas of supply above this one. It can trade past it, even though the charts was telling me that this was a great area to short, and I didn't take it. I was letting the bulls, the regardedness, and cloud my judgment on this one. Uh, mm. This is why you gotta stick to what you're saying, or you gotta stick to the plan. You gotta stick to the damn plan, man. Stick to the plan. And this is actually a great journal opportunity right here. It's a great opportunity to put this in the journal. And actually, I'm probably gonna start setting up the journal during the NA meetings, actually, because now since we're doing the NA meetings live for these plays that may happen overnight, we're gonna start doing these. So today's the 28th. Overnight recap. So we identified a potential area where the bears would rotate price down. What the hell? All right. So apparently I got something. Okay. I'm just gonna have to figure that out later because I don't want to figure it out now. I think it was like what 885 or 995 or something like that. I think it was like 985. Yeah, price rejected. We got a rejection here at 981, and we talked about 985. So we missed that by 4 points. We missed that by 4 points. 985 target or short target. Was there any news released? We had Crash Kari speaking, but obviously he must have said something. And I think it's called the consumer confidence. Yeah, consumer confidence. Consumer confidence at 9 o'clock. So far, the market has reacted bullish So far, there's been a bullish reaction to the release of this news. Sorry, the market you're trading on. So I'm going to be trading on finally the bull side. I'm going to focus on the long side today. So we're about a couple of points away from our first target. I mean, shit, we damn near sniped the bottom on this one so far. We're just gonna wait for our target to fill. Hopefully, these bulls can be just as regarded as they have been this entire week, and we can get this first target hit without any real resistance. Hopefully, if bulls, if y'all want to be regarded, at least be regarded all the way up into this 28 target. That's where we need all that regardedness from. But okay. Trades with, why are you taking this trade? We took this trade because we identified that this could be an area that the bulls would come in to take price higher. I planned on getting in at 18, but I think we may have gotten in at 17 if I'm not mistaken. Oh no, we got in at 18. But it did get to 16. Oh my God. Oh my freaking God. I got to 16. Damn. Damn. God damn it. Okay, so we was looking at 18. All right, so we was looking at 318, but I had a feeling that price was going to get to 316, but I took the 318 entry because I was feeling FOMO as price appeared to be finding support at 18. And this is the great reason why you just write in your journal, because when it looked like it was trying to pump at that 318 level, and we was talking about that 316 level as well. I kind of split the baby on that and put my stop or put my entry at 317, but when I saw that it was trying to find support at 18, I moved it up. I left 2 points on the table because of that. So I should have just kept that 317 entry, but um, goes to show that you just keep your entry. And the reason why I'm taking this hard is on the ES. Every point matters on the ES. I mean, on the NQ, I mean, shit, she throws up points here and there and everywhere. But on the ES, you really have to pick your spots. All points matter. You really can't leave a lot of points on the table because she barely moves. So leaving points on the table is definitely, yeah. And the way that this is looking, we may get this second limit actually hit, actually. Hopefully it doesn't come to that, but it looks like the bulls are done being regarded, and now I guess the bears are now, I swear. Anyway, but we're going to stay in this trade. Okay. We're just going to have to let this play out. All right, so how are you feeling in this trade? I should have trusted the 317 entry because price made it to 316 and every point matters on the ES. So I'll try to remain patient in the future and allow the market to come to me. All right, so I mean the trade is currently playing out. I mean it does look like we may get a double bottom. Honestly, like I said, I think we may get the second target hit, or not the second target, but the second limit hit. I do believe that it may come back down here, and then we'll see a bounce. And I'm putting more risk on this trade because if it trades below this low, then we're wrong. Honestly, we're wrong. But I do want to give this trade enough room to do what it needs to do to find support, resistance, and all that. Honestly, if it trades past this 10 level, it gets to the 9, I'll probably cut this a little bit earlier, depending on if we get down here. I mean, I doubt if we do, but if we do, then we'll just be prepared for that. We'll just be prepared. But we are leaving an area of resistance. And this is why I wish I was in this trade versus trying to find a bottom here. But I think we found a decent area to trade. So we're just going to keep this position. And the same thing with the NQ. Yeah, so let's actually see what they actually stated here. No way. This was not here before. No freaking way, man. Okay. So they're showing that, okay, so this is going to be at 2 o'clock. This doesn't matter. This doesn't matter. Or so this says that the presentation is not available yet. Okay, so it's not available yet. Okay. All right. All right, so let's see if he said anything with the consumer confidence. Obviously, the consumer confidence, it came above expectation. That's probably why we got that pump. I mean, they're saying that the presentation is not available, but they keep talking about it unless this is it.
Is that, for example, makes the ECB very confident about, flagging that if the new projection are in line with the March ones, a cut in June is on the cards, but it does not, the same set of projection does not instill any confidence in wanting to provide any guidance for the July meeting. After all, when you are so distant from the neutral rate, as you showed it with your real interest rate gap, what one can learn in the span of a few weeks that would make you analyze the economy in a different way?
Well, I think what also should be kept in mind is that our projections are conditional upon a market-implied path for the policy rate, right? So if you have projections that are roughly converged toward your 2% target, and as the council you agree that the balance of risk around these projections is roughly equal, no tilt in the up or in the downside. Then in a mechanical way, of course, policy is never made in a mechanical way, but in a mechanical way, you don't want to move away too far from market expectations, right? Because exactly validating market expectations would then precisely feed into your projections that produce the 2% target. That type of exercise you only do once a quarter. Of course, if there are significant deviations in your projection from your inflation target, then you could also at the beginning of a quarter say, well, maybe we need to do 50 basis points and we do 25 today, but implicitly we stand ready to do 25 also at an interim meeting. So data dependence and meeting by meeting means that all meetings are in principle in play. But the amount of rate cuts, of course, is something to be determined by the Governing Council. But we do take into account what goes into the projections and where sort of the projections relate relative to our 2% target and the sort of balanced risk around it.
President Cascari, the situation for the Fed seems completely opposite. You were actually hinting to the fact that policy is restrictive, but you would not rule out a rate hike, and that there might be a set of circumstances that maybe would suggest along the way that perhaps is not that restrictive. Now, I think our question for us is if you can elaborate a little bit more on what criteria you might consider or you have in your mind to basically decide whether policy is sufficiently restrictive or not, what it is that would make you comfortable to say we have to remain on hold for a longer period of time, whether considering the scenario in which you might have to increase policy rates further to bring inflation to target.
I mean, let me just, if I wasn't clear, I think the odds of us raising rates are quite low, but I don't want to take anything off the table. Much more likely we would sit where we are. So we have as you all know, the Fed has officially a dual mandate, stable prices and maximum employment. If the labor market remains quite strong and inflation essentially moves sideways, then I could see us sitting here for an indefinite period of time until we get convinced that disinflation is in fact on hand and their just lags are longer than we had appreciated. But in that time, we might also conclude, hey, policy is actually not restrictive enough. The disinflationary process is not on its way, and therefore that would be the situation where we would potentially have to go up. Again, I don't think it's very likely, but I can't rule it out. I think the more difficult scenario is if inflation moves sideways and we start seeing some real weakness in the labor market, then we have to end up trading off the two sides of our dual mandate. We've said we would take a balanced approach in that case, but we've never defined exactly what a balanced approach means. I mean, I think the 19 participants in the FOMC would probably have 19 different interpretations of what that balanced approach means, and we'd have to look at the bulk of the data. One question, I was at a conference like this a few weeks ago in the US, and market participants would come up to me and say, why do you guys at the Fed keep saying financial conditions are tight? They're not tight. And I'm curious, meaning we think a 10-year US Treasury rate of 4.5% ballpark, all other credit and borrowing is priced off of that. You would say that should be tight financing conditions. But market participants are saying, no, the financial markets in the US are open. They're telling me those are not tight financial conditions. I'm curious, in the Eurozone, do you all feel like these are tight financial conditions for Eurozone borrowers?
Obviously, our guest can offer you also their perspective later. I think when we look at the data from the Eurozone, from our side, we find that financial conditions are very tight, or maybe financing conditions, meaning that, Europe is a much more bank-centric. Yep. And when we look at all the credit data, the data on volumes, the data on interest rate, average interest rate, not just the marginal, which seems to be coming down, we find in the data that clearly, the average cost of borrowing is still going up, and then credit volumes have basically remained lackluster or flat or zero since the beginning of the year. There are some interesting survey data also where where like the IFO, for example, Institute ran a survey data to German companies asking why they were investing so little, and they were mentioning also, the financial, cost of capital. The ECB bank lending survey also showed that, but I'm sure that I don't know whether this view is obviously shared by the policymakers and.
Well, I mean, again, I showed the slide where I tried to depict the deviation of real rates from the model estimates of R star, which showed that in terms of tightness, there was not so much difference between the US and the euro area. If you zoom in on different aspects of financial conditions, the Netherlands, we are a country with a lot of mortgage debt. Mortgage debt is financed fixed term. So the 10-year mortgage interest rate is quite an important transmission variable in the Netherlands. Before December 21, it was 1.5%. In December 21, we started announcing the tapering of the QE and implying that after that rates would be increased. Already in the first half of 21, the 10-year mortgage rate came up to roughly 4.5%.
Yeah.
It's there still today. So it has not tightened any further. Since, let's say, the summer of 22, when we really started raising the policy rate. And the housing market is taking off again. It has had a small sort of pause, and it continues to increase. So in my country, I do not find it easy to say that monetary policy is actually very tight if I look at that specific part. But you're right that on investment, it has been visible that at least corporate borrowing rates have probably been one of the factors that have been withholding investment. Now, I do think that there is also a first glimpse of, let's say, relatively better news there in the Q1 data, but that is something that, of course, we will have to see, because I also agree that we need a lot of investments in Europe to meet the sort of longer-term challenges.
Professor Reitling, you mentioned in your slides that part of your work for the Geneva report basically led to the implication that don't kill too fast this inflationary shock to allow the relative price change to happen and reduce the welfare costs. When you look as of today at the euro area, the US or the UK, where would you say that perhaps monetary policy has not let enough time to kill this relative price adjustment, this to happen?
Well, I've been a very much of a dove since the very beginning, but I'm Italian, so I had to be excused trying to that. I agree that, the mechanism is quite clear. I think that, in monetary policy, people used to think that, relative price changes are inefficient, but actually there are situations in which they are actually efficient, that the economy has to adjust and demand has to, so there has to be reallocation. It is not clear, what that actually means in terms of empirically what that means, and I wish there was more research on that, but it's an example of the kind of shocks that we have just experienced, which at least in Europe was mostly a supply shock. The mechanism, including the relative price adjustment, calls for, for a response that, has to take into consideration the cost of going to the inflation target too fast. And I think the future will be more and more of these examples. And in that sense, there is also research that shows that if you take an optimal inflation perspective, when there are large changes in the trend of relative prices, maybe the optimal inflation should be a bit higher than 2%. There is work by Klaus Adam on microdata, on UK data, and on Italian data. Of course, this is a very difficult topic, and I understand, that you cannot change the target in the middle of the fire, but definitely for the medium run, this should be a topic that should be addressed. I show you the Volcker's numbers that for 15 years, inflation was 3.5, 4%, and nobody was worrying too much, okay? So that, inflation expectations stabilize, although, so the implicit target was higher at the time. There must be lots of reasons. But, you know, talking about to the US, I mean, is it a big deal that if inflation stabilizes at 2.5 rather than 2? You know, what are the costs of that deviation to the extent that inflation expectations are stable?
Mark, you and your team from the very beginning, I would say in November last year, when we wrote our year ahead outlook, you had a view that the Fed would have cut policy rates much less than the market was pricing. You have held to that view for quite a long time. And then after a short-lived, I would say, detour, then you went back to your conviction. And now you expect the Fed to cut policy rates only once this year. I mean, that's a big gap relative to what we expect in Europe, where we expect 3 cuts this year, both from the ECB and the Bank of England. But for you now, where is the risk? Is it more likely that the Fed will not cut, or that will cut twice in 24, and why?
Well, so as you alluded to, I guess as part of the job, I have to put down a forecast for the economy, for inflation, and for rates, and not being in the mind of the policymakers, but trying to think of how the policymakers are going to be confronting the data, given this resilience that we see in the inactivity and in the consumer in particular. Still solid activity on the housing side as well. We think that it will be very difficult for the Fed to cut more than once this year. So our baseline, as you alluded to, is just one rate cut this year. In terms of the timing, it's a difficult one. I think it depends very, very closely on the inflation prospect, assuming also that the economy doesn't suddenly slow sharply. This is, again, not part of our baseline. But if inflation gradually comes down in the next couple of months, so we'll have like a May reading at around a 0.2 for rounding down to 0.2 for core PC inflation, rounding down also to 0.2 for in June, and then around 0.2 in July and close to that in August. Then we think that the Fed might be able to cut as early as September. But even there, I think we don't have too much conviction. We think that it's easy for the inflation to be slightly stronger than that, in which case they would likely postpone the time until they get with the first cut, and that would be in December then. So where are the risks around that? I think the risks are still to the upside in my view, just because, again, this goes back to the consumer. As long as we see the consumer being in overall good shape and the labor market being overall strong, and you alluded to what you hear in your district about from the employers there, and still, seeing the labor market as tight, we think that this can sustain for a while, and it's going to make it difficult for the Fed to cut more than once in that context.
Please, Klaas.
I've been thinking a little bit, Lucrezia, about some of the comments you make. I mean, suppose that the scenario unfolds that is in our projections, and we would sort of be sustainably back at 2% inflation in the mid of 2025, then we would have had 4 years of elevated above 2% inflation. Normally, monetary policy works with a lag of 1.5 to 2 years. Our medium term is roughly associated, etc. So what we have tacitly, implicitly been doing is, of course, extending out the medium term in the face of the shock. I think that was also one of your remedies on the slide. Now, you can have a debate on whether extending the medium term by another year, right, would have been better in terms of lower cost. I would just say that I'm happy that inflation expectations have continued to be well anchored. But there have been moments in which I thought they are just about anchored. The 5-year at 2.65. Oh, these are the moments in which, so I do tend, it's of course a counterfactual discussion. We never know, but I do believe that had we taken more time, explicitly, we might have run a risk of inflation expectations drifting away from us. And if I then look at the real cost in terms of sacrifice ratio, in terms of the labor market, it's hardly been there, right? I mean, no run-up in unemployment. And finally, a higher inflation target, I think, I'm definitely not in favor of it. But the main reason is that after the 1970s, we had to so painstakingly get rid of all these automatic indexation clauses in the economy that creates a lot of rigidity, etc. If we settle for a higher inflation target, at some point, the rational attentiveness to inflation comes back into the picture. And what you will get, Alan Blinder, I think, was quoted once as saying that there is price stability when nobody talks about inflation. At some moment when inflation becomes permanently 3% rather than 2%, at some point people will pay attention. You will get automatic indexation clauses, etc. And in my view, that would only impose even more rigidity on the supply side of the euro area economy.
Yeah, let me answer on two. Well, I think that actually this is exactly what you did. So you implicitly lengthen the horizon of the flexible inflation targeting. Yep. So very good. And for the future, I think it would be good to see some, real concept and some, behind that idea, because I think it's a very powerful idea. And it is really the essence of flexible inflation targeting, that you want to, adjust the horizon in relation to the cost. And in terms of the level of inflation targeting, which would be another way to do it, I don't think you should change it now, but actually in a report of in a kind of reaction to your strategy review, we wrote with another bunch of economists that it would be good to have a system in which ex ante you revise it, but giving the date for the revision ex ante, because of course everybody understands that you cannot do it when inflation is high. And the reason is that, 2% is relatively arbitrary. So we know that it is. We know that it cannot be 10 because otherwise we have the indexation spirals of the 70s. But between 2 and 3, you can see that 3% is not the end of, so why not 3%? Okay, so, and now it's not 3% because you have a target at 2%. And so it should be 2%. And you should adjust the horizon. That would be my recommendation. But, I think for the future, especially if you think that there will be other shocks of the kind that we have experienced, I think it would be good, to have some kind of concept for revision on a regular basis.
Great. I think so far we have spoken a lot about interest rates, but we have not mentioned balance sheet policies. Those are also part of the picture.
Yeah, so on that topic, I mean, I guess President Kashkari, the FOMC announced a change to the rundown of its balance sheet at the last meeting. Can you tell us a little bit of what's underlying that decision, how that relates to the policy stance, and maybe any insights about when do you expect this to end, or if any?
Well, the Federal Reserve successfully shrunk its balance sheet after the great financial crisis. It grew very large, and then we went through a period of quantitative tightening. We did that successfully. We shrunk it a little bit too much because the demand for reserves continues to climb, and we weren't exactly sure. We were surveying banks about how many reserves that they would need to get to this ample regime that we are trying to operate under. And it turned out that demand for reserves was somewhat higher than what banks were reporting to us. So we were surprised. This is in the fall of 2019. We saw some volatility in funding markets, and then the Federal Reserve had to intervene to provide more reserves into the financial system, and then begin growing our balance sheet again through normal processes. So then we expanded it again during QE, and now we've been shrinking it. Now we've been shrinking it at twice the rate we shrank it last time. So it's been a very rapid runoff. And all we've now done is said, let's go slow the runoff back to the runoff pace, essentially, that we had during the last quantitative tightening period. So no one should interpret this as we're ending quantitative tightening. All we're doing is slowing the runoff so that we can begin to monitor market signals for when we are eventually going to get at that ample reserve regime. There's a lot of ambiguity about that. The demand for reserves continues to change, continues to grow. The events in the banking sector, Silicon Valley Bank and some other bank failures, has also heightened focus on liquidity for banks. So we're not exactly sure when we're going to go from this super abundant regime of reserves to an ample regime. And I think we're gonna really focus on market signals, where federal funds rate is pricing and other short-term market signals to give us that indication of when we're getting close. And we just want to slow things down a little bit so we have time to monitor those market signals. But it's not going to end up changing the destination.
Very good. Thank you. And to you, President Gnott. So far, all is going smoothly on European bond markets, and draining liquidity so far has not created any issues. But from the Fed's perspective, as President Kashkari just mentioned, we learned that it can go smoothly until it doesn't. How do you think about the unwinding of this balance sheet process in Europe?
Well, I mean, for us, it's been very clear that we had identified rate policy as our primary instrument to tighten policy. That was simply the instrument we knew best. We have never done QT before, and in the European context, I think there is an additional layer of complication with balance sheet policy that has to do with the fact that we don't have centralized federal
that was
debt
literally
that
like
we
3
accumulate
points
on our balance sheet, but it is national debt, and there is always the spread issue, and sort of that bond markets in the euro area can get to be quite sensitive to these kinds of decisions. So we have opted for a slow, gradual, but predictable approach, running off the APP, and from the summer onward, running off 50% of the PEP, and then from January onward also full runoff of the PEP, simply through a discontinuation of investment. To sort of guide that process, we have announced that we would tighten the gap between the MRO rate and the DFR rate in terms of our operational framework review, in order to create as little room as possible for undue volatility, let's say volatility that was not helpful in terms of setting the monetary stance. And now in the coming years, we will simply have to see where that winding down will take us. And at some point, of course, we will also hit the point where excess liquidity will have been effectively removed. But we will see that in terms of more pressures, more volatility in the money market. And that is the period in time in which we have to start thinking about how we want to shape our structural liquidity provision operations. That's going to be a mix of refinancing operations and bond holdings. Very likely, when that structural operation will become relevant, we will start from a position where we will still have significant bond holdings, but no refinancing operations anymore. So if we then have to expand, probably we will first opt for refinancing operations until we have the right balance that we want to see in our structural operations between the two. But my anticipation is that for the coming years, it will be a gradual process of winding down our balance sheet, and then we will have to empirically find out where the optimal level of reserves will be.
Professor Reichling, you helped build up the long-term operations at the ECB, right? Pre-global financial, when you were at the ECB, you were also doing long-term operations during the global financial crisis. I think you were there at that point. Any comment or anything that you might have on this process of balance sheet reduction?
Well, one is that the ECB had an experience with QT, okay, when the LTRO were repaid during the big periods of deleverage. that wasn't very nice. Well, I mean, I think the ample reserve, I'm a fan of the ample reserve system. I think it's quite, it's robust. It has a lot of advantages in terms of control of interest rate, in terms of having two instruments, one for liquidity and one for interest rate. I understand that it is more difficult to apply it in the euro area because of the lack of a unitary treasury market. But if we abstract for that problem, which is, it's a problem which I would say a political economy problem more than an economic problem, I think that definitely, to go for ample reserve, it's, in my view, I mean, I don't have much experience in operations, but in my view, that would be much more robust than risking to get close to the kink of that curve for the demand of reserves, where actually, the volatility of rates could get into the
let's go back to rates. Okay, so in markets, one of the key issue is to what extent can the monetary policy of the Fed and the ECB diverge. Normally, the Fed is really seen as the Stackelberg leader, right, in setting interest rate, and the ECB as the follower. President Knott, do you think that there could be any constraint, and up to which point can the ECB embark on a cutting cycle on its own? Let's say, can the ECB cut 3 or 4 times policy rates, as you were mentioned in your chart, the prediction from the chart you showed, if the Fed were at most perhaps cut policy rate once this year?
But also that we have to find out. I mean, we both have a domestic mandate that we have to focus on our own inflation outlook. But clearly, monetary policy always takes place in a global context because there are global spillovers. At the same time, it's not so clear in what direction these spillovers would take you in the current context, because it may well be true that if we cut more aggressively than the Fed, that might lead to a lower exchange rate on our end, which would then be inflationary. At the same time, less rate cuts on the Fed side also means an overall tightening of financial conditions, of bond market conditions, which tend to have a strong global component with global spillovers, which will also spill over to the euro area. So if the Fed cuts less than expected, then we will get 2 opposing effects. And we will simply have to observe which of the 2 effects actually is dominating in terms of our inflation outlook. And that will have to decide what room for maneuver we will have in cutting interest rates. But it's not necessarily clear that movements on the US side move in one direction for us or in the other direction, given that it is multiple channels and they don't all work in the same direction.
And President Kashkari, normally we never think about how the Fed can internalize policies from other central banks, right? We see it, as I said, as the leader. How do you think about it? Is there any consideration from your side of internalizing, or which impact could the ECB policy stance have on the US?
I thought President Knott said it very well. I mean, we pay attention to the rest of the world because the rest of the world matters to the US, even though our mandate is a domestic mandate. And so we run models and we look at what's happening all around the world and we factor that in. But ultimately, we are accountable to our government, just as the ECB is accountable to the European citizens. These deviations, they happen. And eventually, the advanced economies tend to move kind of together over time. But they're deviations in the short run. So personally, I don't think it's a huge deal. I think we're all going to do what we need to do.
Mark, can we do it? Will it happen?
I mean, you and I and our teams published a piece not so long ago, I guess in April, looking at the size of these discrepancies.
That would have been our first
exactly
target.
Point. I mean,
right there. That's why it's important to just stick to the plan. Our first target just got hit.
Along the projected path.
But now we got to wait an extra 2 points to get our first 10-point target.
And in Europe, the gap would not be unusually large, not much larger than actually not smaller than what we've seen in many instances since the early 2000s, including just before the pandemic as well. So nothing really dramatic there. It might lead to some adjustment to the exchange rate, but I think
maybe the last question on this divergence, because it was brought up at the very beginning, right? It was a long-term divergence in terms of productivity growth. And I think the interesting obviously, the productivity growth has been much stronger in the US than in the euro area since the global financial crisis. I don't know, perhaps to you, President Kashkari, what are the factors that you think are worth underlining, and what could Europe learn maybe from the US in terms of enhancing its productivity?
Boy, that's an impossible question to answer. Why is U.S. productivity growth right now as high as it is? It's higher than it was before the pandemic. Is that it's just a residual of a bunch of other measurements? So, could it revert back to normal levels? At this point, I think it's much too early to say that AI is showing up in the economy. The history of productivity developments and new technologies would say it's going to take a long time. If it shows up in the official statistics, it'll probably take a long time before that. So I don't know. I mean, economists point to flexibility in the U.S. labor market. as one possible source. We know that there's been a lot of
Yeah,
new
I think we can
business
get
formation
this
in the
first
US
target hit.
beginning in the pandemic, but it's been sustained
If
remarkably
it gets to
well.
27 and
That
starts
could be
acting
another
up,
source, just
then
basic
we'll take
business
it.
dynamism.
We'll take the 9
What
points.
drives that? What drives those animal spirits? I don't have any good suggestions. It's a tough one.
But as long as we can get
Professor
that first
Wright, you
target
in the
hit,
past many
everything
times
else
brought report
is just
also from the
gravy,
CPR with
icing,
the CPR
whatever you
colleagues
like to put on
shape
top
up
of cake.
European institutions. We have European elections this year. Anything that we could expect from, again, we are both Italians, the two Italians.
I see dark.
Exactly,
I see very
this
dark.
report, the Letta report, the Draghi report, can we expect that anything after the European election will be put on the table to enhance productivity in the euro area?
Well, Europe, if it wants to survive, has to get its act together, I think, in a lot of challenges. So we cannot continue to be prisoner of our fragmentation in many ways.
And President Knott, the ECB is not shy in giving advices to governments, whether it's on fiscal policy, on structural policy. What would be your advice or hope for after the European election?
Well, I'd prefer to say a few things from a more analytical perspective on productivity. I mean, productivity has been negative in the euro area. In the first quarter, it was 0, which is no longer negative, at least. Probably there is a cyclical element to it, but also a structural element. And the cyclical element might go away if we get more recovery. And maybe if we had had the fiscal policy of the US with, well, much larger deficits, much more stimulus, the cyclical element in Europe would also have been smaller. But the second point that I've been making in this context, then when you think about the impact that fiscal policy has on productivity growth, it's not only the size of the fiscal stimulus. I also think that the design of the measures during the pandemic, which in the US were basically focused at companies laying off workers, providing income support, and then in the recovery have the workers being rehired. Whereas in Europe, the support was paying the firms to keep the employers at the payroll, even if they were not productive at that moment. So what you're saying in terms of new startups, in terms of labor reallocation, which is massively taking place in the US, we have frozen in Europe the supply side of our economy because of the design features of the support that we gave. And I think it's an interesting research question, whether that differential nature of fiscal support is also one of the factors. The lack of dynamism we have had on the supply side. First, the freezing because of the pandemic support, then the labor hoarding during the, let's say, the quarters in which we had stagnation, etc. Whether also that lack of dynamism is a factor. And that is for us, I think, very difficult to mimic because the character of our labor market is fundamentally different. If we were to do a US-type experiment in Europe with massive layoffs and then the rehiring, elderly workers would probably not be because we don't have a tradition that elderly workers will be rehired. In the US, you hire elderly workers as easily as younger workers. So I think it's that structural difference in the labor market that for me is also an important part of the puzzle, but there are no easy answers for it.
But can I add one quick thing, which is, I agree with everything you said, but I remember the policy deliberations when the pandemic first hit. And there was a lot of admiration for the European system of keeping workers attached to their firms, and a lot of hand-wringing in the US that our system is so barbaric. I mean, that's a harsh word, but our system is so backwards relative to the enlightened European system. Fast forward 4 years, and now you're saying, well, maybe it wasn't as enlightened as it appeared 4 years ago. I'm not here to judge one way or the other, but it's just interesting how perspectives can change over time about the same very basic programs.
I agree.
Damn, Kashkari was like that.
But I see we are already running out of time. Before
it's like that.
Space to our audience with the Q&A. I just want to ask you what I call a classic one. So it seems to me that broadly speaking, we are
damn, Kashkari hit him with that clap back. It's like you was talking all that good shit a couple of years ago. Now you're trying to do the same thing.
Goldilocks
That's crazy.
Scenario where growth remains solid or will improve in the euro area. Inflation is going down to target, whether faster or slower. But sort of speaking, a very positive outlook. I always think, what could we be missing, right? What keeps you at night? Obviously, it's a metaphoric question. I really hope you all sleep very well at night, but very quickly, maybe starting from you, President Knott.
Geopolitical risks, I think, by far, and not just because of their monetary policy impact, by the way, but also because, I mean, the Houthis will still be there 18 to 24 months from now. So the current running up in shipping costs, we really have to monitor whether that is truly a temporary effect or.
Hopefully, I didn't make a
not.
mistake, guys. Hopefully, I
We
didn't
have
make
a
the
war,
mistake.
in
I
Europe,
had my
which is
I had my limit
nowhere near
at
the
28
end.
and a
There
quarter.
are more autocrats that
And it
have
looks
full
like
geopolitical ambitions.
they came in at 20,
and
28
all
even.
these,
And
Europe will
now they're
always
trying
be
to
in the
rotate price
epicenter
lower.
of
Hopefully, I
the
didn't make a
economic
mistake on
consequences
this.
of this.
Hopefully, we can get this
These
target hit
geopolitical tensions, since
before
we are so
a
much
potential
dependent
rotation
on
down.
international trade
But
and the open rules-based system that we try to build after.
that kind of sucks. That definitely
Professor Reichen.
sucks.
Yeah, I would
I'm not gonna
agree.
lie.
And
I
as
still
a
think this target
European,
gets
what
hit.
I'm worrying about is that
What I'm
our
hoping is that it
system is
doesn't
not
have to
fit for
rotate back
purpose
down
because of the
and
fragmentation
come
of
back
fiscal
up, because
policy, the political
that would just kind of
fragmentation.
be.
So that means a lot of responsibility for the only federal institution that we have, which is the ECB. So I think that we have survived the crisis of 2010, 2011, a big geopolitical crisis like this in the making. Maybe it will be a harsher test.
Professor President Cascard.
So in addition to geopolitics, one factor that we haven't talked about yet, which I don't think is a financial stability risk, but it's nonetheless a risk to the U.S. economy and presumably the European economy, is commercial real estate.
Okay.
We expect there to be big losses in the commercial real estate sector. We think we've studied it very carefully, that most banks seem like they are well positioned to handle those losses. But my experience in the financial crisis of 2008 is usually there are surprises on where those losses end up, which balance sheets ultimately are exposed to those losses. And when those surprises reveal themselves, that's something else that I'm concerned about. So we're monitoring very carefully, but I also know that we're going to be surprised where some of those losses end up.
Mark.
I think we have a long list of things to worry about here, and I worry about all these two. I think I would just add to that maybe the prospect again of ending the year with an inflation that's slightly higher than what we.
I mean, technically, price is sitting here at this range.
And then starting 2025 with a renewed set of inflationary pressures in the U.S. in particular. Things like tariffs, for instance. We haven't really had time to talk about it just yet, but also we benefited a lot from immigration, a big surge in immigration, and next year we are likely to see some curtailing of that immigration, which might put some additional pressures as well on the labor market again. So
I mean, I think this first target is good. I think it's good.
The whole work of bringing inflation back down a little harder.
Thank you. And perhaps with that, with the high for longer, then financial stability concern could become more relevant. But let's go now to our audience and Q&A. I think the way we would do it is that we collect 2-3 questions together. So please introduce yourself and then to whom. Mike's are around.
Damn, the whole broadcast went off? Okay. Okay. So it seemed like the broadcast, whatever happened, or maybe they cut it. Who knows? Let's refresh the page, and if it doesn't come back on, then yeah, okay. All right. So hopefully we get another chance at this first target. Hopefully we get another chance at this first target. I mean, the pressure would have been off if we got it. That means we paid ourselves. I do think it still gets up here. It's just that now we're just going to have to wait for it. The Bulls, I'm kind of ashamed that the Bulls now are not ashamed, but where's all that regardedness? I mean, where's it at? Where's all that regardedness at? Why all of a sudden that now you're having a hard time pushing price up higher? Y'all been doing it all goddamn week for the last 3 weeks. What's up with that? Uh, okay. Yeah, hopefully this ain't. Oh man, that would just suck. I'm not gonna lie. That would suck. The price gets back down to break even. I mean, obviously we would have to actually break this 20 level. We would have to break the 20 level. The Bears are trying to push this down. Now they're trying to show up. Man, I swear, these rainbow bears only come out when you don't want them to. These rainbow bears are always shorting at every place except for freaking resistance. Except at resistance. They don't ever come in right here. They like to come in the middle of the chart or at the bottom when the bulls are trying to get their rotation higher. But when price trades up into resistance, they act like they're non-existent. These rainbow bears. But unfortunately, in this situation, I think we missed our first target. I mean, we missed it by literally a quarter. We missed it by a quarter. So hopefully price doesn't have to triple bottom here. I mean, honestly, if it rotates, rotates lower, then I think, fuck. Boy, I swear, man. I guess this is part of the game. We missed it. We missed it by a quarter. We missed it. So, damn. All right, so let's put that in our journal. I mean, like I said, I think the Bulls are going to come back in, but man, damn. I mean, it's just heartbreaking missing that by a quarter, literally a quarter. That's just heartbreaking. That's heartbreaking. But let's put it in our journal, man. That's heartbreaking, man. Yeah, that's heartbreaking. So I guess we don't get to see the question and answering and see what the hell they talking about. Let's try to refresh the page one more time. See if whatever the broadcast, whatever happened to the broadcast comes back up. So all right, that's fine. That's fine. All right, so this is how am I feeling in this trade, man? We missed our first target by a quarter. We literally missed it by a quarter. And that's heartbreaking. I still believe that price will continue higher. but price coming back close to our break even is heartbreaking. Like if he was able to get that first target, and if price did, well, it did reject here, we can add to the position. We can re-add to the position for a potential move back up higher using our profit for an opportunity to get some more money. So if the bulls do come back in here, shit, honestly, in this situation like this target is no longer good enough no more. It's no longer good enough. We're $28. Yeah. Yeah, that's heartbreaking. I apologize about that, guys. I apologize. We missed it literally by a quarter. Literally. Okay. We're still in this trade, so it hasn't even traded close to our stop. It hasn't even traded close to our scaling. Man, that's frustrating. Okay. All right. So, like I said, we're still in this trade. It's just unfortunate that price came back to our, or is getting closer to our break even. That's just the unfortunate part. The bulls are still showing some strength here. It's just that these rainbow bears came in the middle of the chart instead of coming in here at resistance like they should. But I guess bears are gonna be bears, right? Bears gonna be bears. All right, so we've done that. I still think this trade is good. I mean, even if we were to take the profits now, I mean, you're up $300. I think what we reached about like almost $700 at our peak. So I mean, it's yeah. Okay. Yeah, I think they're done. So our next set of news doesn't come out until Oh, I guess this 2-year note auction. That's going to be the next objective for the market. We got that in the next, what is it, like 21 minutes? So we'll see how this comes out. And then at 12 o'clock, we have the 5-year note auction, which I'm pretty sure it's going to have little to no effect on the market. I hate that it switches this. I don't understand why it does this. I don't ask it to do it, but it does it. All right, so this is the NQ, and it looks like that triple bottom was definitely lucrative if you took it. That triple bottom was definitely lucrative. So that 839, it got all the way back up. So this is a 100-point move almost right here. It's a 100-point move. So if you took that triple bottom, congratulations. That was almost a 100-point move right there. And it does look like there's a lot of volume in this 915. So 915. So this range. So 915 to 924. Let's look at that. So 915, 924. So from here to here, it seems like there's a lot of transactions that happen in this little range right here, according to the volume profile. So, and coincidentally, you can see that there is a rejection here right at 915. We came back into it, and we got that break of structure right here at 915. We rainbow bears. Okay. Hmm. All right, so let's see. Let's see if these bulls can hold it, because I mean we do have a higher high. It does look like they're going to push past this high right here. And honestly, huh. So this is what I'm gonna split the baby on this one. I'm splitting the baby because I didn't like that. I didn't like that at all. I did not like that at all. Splitting the baby on this one. Mm. Well, that don't make no sense. That's only 1 point. Hmm. And the good thing about this, actually, the good thing about this is that once we get that first target hit, we can actually move our stop actually to break even plus, like literally break even +1 for real. Because if it trades below this low, then shit, then that's just done. That's done. Yeah, it looks like they're trying to sell it right at VWAP. Rainbow bears. Rainbow bears, I swear. Okay. All right. Let's make sure that if the Bulls are, or if the Bears are successful here, let's just make sure that we're prepared for this. Yeah, I think this position is as good as it's going to be. I mean, in order for our stop to get hit, the Bears would definitely have to take price all the way down here. And if price does come down here, we do have our scale in ready. Probably bump this up to 1425. We have our scale in ready to scale into this position. And yeah. But yeah, it's just unfortunate that we missed this thing by a quarter, man. That's so heartbreaking. We missed it by a quarter. Yeah, we missed it by a quarter. Uh, yeah, I remember the last time we had a triple bottom on the NQ. That was back when price pumped all the way to that 17K, that number that we thought that it wouldn't get to. And I remember that because I think it was obviously earlier this year. We had a triple bottom, or was it? Because we got that massive pump to 17K. Yeah, so I think obviously it had to have been this. Yeah, I think this is probably it because we had like a triple bottom in this in one area. Yeah, 1, 2, 3. Yeah, I think this was it. Because price was consolidating back and forth. And then we had a triple bottom. And then price shot all the way up until 17K. So it has to be this. Because this is the only triple bottom I see. Yeah, it has to be this. Anyway, the reason why I say that obviously because we had a triple bottom this morning. And as soon as I saw that triple bottom, that's exactly what I was thinking about. I was thinking about how the last time we saw a triple bottom, we had a massive move higher from that triple bottom. And as you can see, we had this 1, 2, 3 triple bottom right here. So I wouldn't be surprised if our next stop is to take out these highs. And then obviously take out all-time highs after that. I wouldn't be surprised. Honestly, but I doubt that we get it all in one session. I doubt we get it in one session. I doubt it. All right, so it looks like we're about to get a second chance at this first target. But what I'm going to do actually, instead of letting price come back, I'll trail it. Once price gets up into this area, I'm going to move it up. I'm going to trail it. Let's see if we can actually get some more points for having to wait for that retest. So as soon as we touch this high at 28, I want to see if we can push past it. And then I'm going to start trailing price to take me out 10 contracts. And hopefully we can possibly get a retest of this high right here. So to get a little bit of extra points for waiting. He said, hold on, he said, you just transferred $150 from, he says, Operation versus Sherman was successful. Hey, you did that in the Qs. You did that in the Qs. But congratulations on that, man. Honestly, I kind of wish, well, I don't wish for anything. It would have been nice if I actually took out that money from my options account instead of gambling it away. I should have recognized that I was starting to gamble. I should have recognized that, obviously, in hindsight. But that $1,800 would have been nice sitting in my account. If I should have withdrew that and started again at the 500 when I started to gamble, but you know how it should go. When the money comes easy, it goes just as fast. It goes just as fast. The Q, SPY, and XBX. You traded XBX? Says needed for an activation fee for an ETF eval. Who has an ETF eval? Who has that? Who's doing that? An ETF eval. Huh. Oh, Elite Trader? Really? Really? And I'm actually thinking about getting these diamond hands, man. You said it's 80%. Oh, is it still 80% off? They changed it? Hold on, they changed it? Yo, what the fuck? Huh, did they change this? Because this used to be this wasn't this before. It didn't have a max drawdown of 3,500 and a daily loss limit of 1,500. This was, I could have sworn this was exactly like what is it? Apex's static account with the same thing. It's just that you could have held it over the weekend and overnight. Huh. No, I have not heard of the shark indicator. No, I haven't heard of that. What is that? I could have sworn. Huh. Maybe I was mistaken then. I could have sworn this was exactly like Apex's static account. So the shark indicator is basically building your own bot with your own rules. Oh, okay. Create trade signals, tracking nodes, third-party indicator. Okay. We got a 32. Okay, so anybody interested in creating your own bot, they're doing a free trial. And apparently they're doing a Memorial Day sale as well. And they're selling it for about $800. Yeah, thanks for sharing that. So they got an ETF. Oh. I mean, I will go back to trading SPY if I can use somebody else's money. Since you can only use Ninja Trader, yeah. You know, I find it interesting because, like I said, I work in the engineering field. I find it interesting that these guys code their way out of. I can see it from both sides. I mean, what they're doing is obviously, they automate a lot of code. But at the same time, you kind of do need somebody knowing what the hell they're doing to fix code when it breaks. But I mean, if you got Chat GPT automating simple codes or simplifies the code, it kind of does lessen the demand for coders. Like you can't go to an employer and demand a high six-figure salary when you got a lot of the code automated. And once the code is built, honestly, all you need is maintenance. I mean, if you add features, I mean, you can outsource and contract a team to add features to any application. But for full-time developers, I mean, a lot of that code is automated. So, like I said, mm. Okay, so it's 10:30 now. So we do got London code, or not London code, London close. It's 10:30. Oh, do they? Okay. Do you use it yourself? And if so, how are you liking it so far? Hmm. Hmm. I'm gonna keep my eyes on this because they changed this. There's no way they changed this. They changed it. So I'm gonna wait and for the next 80% sell. I know Alfred, you sent me the and at the time I didn't look at it because I'm sitting here thinking that I had to really think that do I really want to try to test out 625 in drawdown with a 2K target that you can hold overnight? Because I swear, I mean, even if we gap down, especially over the weekend, would this be a great use of my money? But they must have changed it because this is actually a really good deal. This is good. A 5K profit target. I mean, you do have a daily loss limit, but hold on, is this and it's an end of day drawdown? Yo, okay. I'm keeping my eyes on this now. Oh shit, did I miss it? All right. Did I miss it? Yeah, what the hell? Hmm. All right. Hmm. Yeah. Oh yeah, the bond auction. Let's see what it says. Let's see what it says. So I mean, it looks like the high yield, or never mind. Let me see. Let me make sure. Yeah, so it seems like the high yield came in under expectation. I don't know if that's a good or bad thing. Or I mean, the bid to cover came in under expectation, but this came in above. All right, so I certainly won't pencil in more than 2 cuts. Really? We didn't get a pump from this? We got a dump? I certainly won't pencil in more than 2 cuts for 2024. We didn't get a pump from this? Huh. That is surprising. How did we not get a pump from this? How did we not get a pump from this? Okay. That's interesting. So he also said that he doesn't think that weakness in the economy is needed to lower inflation. So he's saying that the market doesn't have to be weak in order for inflation to lower. And we talked about this. We talked about this, and it seems like I mean, even in geopolitical, we see these stuff happen in foresight here on this channel. So we talked about the direction that China and Russia is heading towards with the movement for de-dollarization. We've already spoken about how resilient, if you want to use that word, China has been, coming from not even a second thought to a political economic power that rivals that of the United States. Mind you, that's been in business for over hundreds of years. So you have to really put that into consideration, that the United States and their grip on geopolitical, let me rephrase that, their grip on the economy, the influence, having your currency as the reserve currency. The United States has been doing this for a very long time. And for China to come out of nowhere and just rival the United States, that it within itself is an accomplishment. And you can't turn a blind eye to that, because that takes drive, that takes planning, that takes ambition. And obviously, China's president has a goal to achieve, and he's not going to stop until it gets it done. And I'm pretty sure if unfortunately something were to happen to this president, I'm pretty sure there's a system that's already in place to replace him and continue to go. So I know that a lot of the reason why I say that is because that's how a lot of underdeveloped countries got destabilized, by killing its leaders. I mean, that's the oldest trick in the book, is if you cut off the head of the snake, the body will fall. That's the oldest trick in the book. And I'm going to assume that there's already something like that that's already in place, so this plan can continue to go with or without this president. So you already see that the U.S. and its partners are prepared to use sanctions and export controls to prevent China and Russia to trade that threatens the collective security, meaning the dominance of the U.S. dollar. So that's something to keep an eye out for. Could stay on hold. Says we can stay on hold for an indefinite period of time. I think the odds of the Fed raising rates are quite low. So, I mean, on it, like I said, I'm surprised that we haven't gotten a pump from these statements yet. I'm surprised, honestly. I am surprised. And so, yeah, if this pushes past, we're definitely gonna probably hit this target then up here. But I'm like I said, I'm gonna probably trail this, and I'm probably gonna move this one up here because at this point, getting out at here would be cheating ourselves. We might as well wait for the full rotation to happen because let me just draw this out so I can show you guys what I'm looking at. Because I mean, obviously, price is at the bottom of this range. I mean, the bulls are gonna oh crap. Okay. So the bulls are looking to actually break through and possibly break out. Now the bears can potentially hold the bulls at this bottom of this range, but they haven't done it. They've tried already. You can see that they've tried once to sell price down. Actually, they tried once, twice, three, four, and this is the fifth time they've tried. So obviously what they're doing is not holding back the bulls so far. So that tells me that price is going to go and continue up higher, and we're going to possibly trade at least until the top of this range. And if the bears are actually here and we do get this breakdown, then okay, I mean, it's at the top of this range. But if the bulls are able to trade through this range, we get a breakout. Honestly, I don't care. I mean, as long as my target's key, I don't even care at that point. But if we do get a breakout, you're going to want to see the bulls at least stay right here at this 28 level if we do get a breakout. And then from here, we will want to see a move up higher. So yeah. Let me actually, man, I hate, I'm gonna have to actually do something about that. I'm gonna have to do something about that. I mean, if that means that I have to, because it's getting close to the time where I actually go for my my meeting, and it seems like the market always want to move against me when I leave the damn screen at this time. Come on, baby. Yeah, there's no way that this dumps. Not here. Not after that many tries. Not after that many failed rotations lower. Yeah. Being an ES trader, just watching paint dry, I freaking swear, man. All right. All right, so the NQ did take out this high though. We did get a drop, and the bulls are still trying to push price higher. They're still pushing. Still pushing, man. Still pushing. It would just be nice if we just get some of that regarded action that the Bulls got last week. It would just be nice. Okay. I mean, we're getting back to that spot now. Hopefully we can get a breakout. Hopefully we can get a breakout. That would be nice. Well, let me look at this real quick. About 28. No, 28. And then this is 29. And that's 30. All right. Yeah, about 29.50, 29. But then you got this high at 31.25. Or actually, I mean, is this meeting still going? Hmm. Ah, man. Yes, why do you break my heart like this? Yeah, I'm gonna probably have to pull this up at my other workstation. Um, all right, guys. All right, I'll be back. Let me get this done. Hmm. All right, so I've been working this is another time. This is my trigger to trade. I did not have to. I think I'm actually still reviewing this one because I'm trying to figure out what this one is actually talking about. It's saying that this guy went to a website. The website itself was. I'm trying to figure out what I'm actually talking about. Do you actually have any insight on what this one is actually? Yeah, so I'll put a review of this one. It's about 5 minutes. That's all I have. I remember this one. This is a I already related this to and I thought this but I have All right. So let's see. All right. And yeah, I'm actually going to shut down the stream in a couple of minutes. I do want to see if we get this range breakout though. I do want to see if we get this range breakout or if the bulls fail here and we get a crash down. I am still surprised that the market didn't react to this. How do you not react to this? It says, I certainly won't pencil in more than 2 cuts for 2024. How do you not? How does the market? I mean, these bulls have been so regarded. I mean, bulls can be definitely regarded at time. Market participants are just, yeah. So we pump while Powell was sitting here saying that, nah, we ain't cutting no kind of rates no time soon. We get this massive pump up. And here our boy Crash Kari says that I won't pencil in more than 2 rate cuts. And the market is like, yeah, okay, don't do anything. It is crazy, yo. This market is crazy. This market is definitely crazy, man. Crazy. The market literally did not react to that at all. Okay. So at this point now, since we're turning over a new leaf, we can make this a risk-free trade. We can cancel this scaling, and we can make this a risk-free trade. I probably still will take my 10 points here. I just really want to see if we're going to get a breakout. That's what I want to see. Honestly, 20. All right, so this might be our breakout right here. This might be our breakout right here. Let me actually get my trailing stop. This might be our breakout right here, boys and girls. This may be it right here. Man, come on, man. Come on, break out. Come on. Come on. Break up to the outside. Break up to the outside, upside. Break out to the upside, baby. Break out to the upside. Huh. Boy, what a tease. What a freaking tease, yo. What a tease. What a tease. What a tease. Let's get in queue real quick. What a tease. I'm gonna wait for this candle to close, actually. I'm gonna wait for it to close. and I'm waiting for it to close. God damn. All right. All right. Okay. All right. So let's all right. So now the trade's a risk-free trade. I still think we're gonna probably get a breakout, but if we don't, dude, whatever, man. What, dude, whatever, whatever, man. Like I said, I just hate the fact that now all of a sudden all the regardedness, now that we finally got a decent pullback for the bulls, now all that regardedness is gone. I mean, they were buying tops and pushing, and we get a decent pullback, and the market is anyway. So right now the trade is a risk-free trade. It says I had 3 opportunities to take the 10-point target, but I've decided to hope for a breakout, which does not appear to be happening right now. I really wanted to get a little bit extra because of the multiple moves to break even. And I feel that the first target is not enough, even though okay. So right now I'm just accepting the outcome of this trade. I've had 3 opportunities to get out at that 10-point target. I wouldn't say the first time when Price missed our target by that quarter, I wouldn't call that a mistake. I mean, how would you ever foresee that we'll miss our first target by a quarter? If I allowed our original entry at 17 to stay, I mean, it would have been out at that first target at that, obviously at 27, a point before we got that first initial rejection. We could have paid ourselves and mm, and I won't say that I kind of went tilt, but that frustration of missing that first target, that definitely that's definitely has kind of altered how I'm looking at this trade because now internally I feel that that first target is not enough. Is not enough no longer because of how price retraced the way it did and price coming back into that same area. Now I want to look for higher price or a higher price or a higher exit to compensate for that retracement. But what I won't do is allow price to trade past my break even, turning this trade from green to red. I won't allow that to happen. So right now, I'm hoping to get a breakout to the upside. I mean, the structure is still bullish. The structure is still bullish, and that's why I'm still in this trade because of the bullish structure. We're still making higher highs, or I'm sorry, higher lows, and we're still making higher highs past this high. So I think I may just have to be more patient in this trade to get the target that I want. But like I said, we're not going to allow price to trade back into our break even. We're not going to allow that to happen. So that's all I have for right now, guys. We'll come back and do this again tomorrow. Or actually, so with tonight's NA meeting, I'm going to try to make it. I'm about to meet up with my brother around 1, 2 o'clock Central Time. So I should be back in time. He had his birthday yesterday, and we're just going to go out and eat and kind of celebrate the day or the anniversary of his birth. And that's going to be 2 o'clock in the afternoon, and we should be done way before the 6:30 NA start time. But I may not release the actual shorter version to where I'm just talking about the levels and stuff like that. So everything will be said in the NA meeting. And last night's NA meeting, like I said, we called out this 39 top to the T. And like I said, I kind of wish I took it. I kind of wish that if I was not going to take it in this, if I wasn't going to take it in this account, I should have took it in one of my throwaway accounts just to test out my theories. And that's probably something I'm going to probably be doing moving forward. I'm probably going to get, because I have some throwaway accounts that I just use to test my theories out. And what these accounts help me do is it really allows me to, once we get into these accounts that we actually trade and we're actually following and growing, I know not to take certain trades because I know that it doesn't work. And that's what these throwaway accounts are for. But it worked this time. So that was a great trade. All right, so let's see if we can get this breakout. Let's see. I mean, this is like the 10th. What is it? 1, 2, 3, 4. This is the 5th time. Come on, Bulls, push it. Push it, push it, push it, push it. There we go. There we go. Take that high out, baby. Take it out. There we go. We get that breakout. Come on.
Order filled.
All right, that's cool. We got our 10 points. So we paid ourselves today. And now the only thing left now, oh crap. What the hell? I was about to say, like, what the hell? All right, so we paid ourselves. So we could put this at 31. Probably put this at like 30.75. We can put that right there. We can have that test that. And if the gods will allow us to, the market gods will allow us to, nah, it's not gonna break over this high. We probably might get it right here. All right. All right, guys, we paid ourselves. We got our all right. Great trade. Great freaking trade. We got the breakout we was looking for. So that means that price is most likely going to trade up higher. But we're going to take our first 10-point target, even though it took all freaking session to get it. All right, so now that the pressure is off on this trade, how did it play out? So we got our first target. We got our first 10-point target. And now all we are waiting for is our runners to get hit. Now all we're doing is waiting for the runners now. Hopefully, it'll be nice if we can get it. It'll be nice if they'll allow our targets to get hit, our runners. Okay, but all right, guys. Like I said, great trade. We'll do this again later on tonight. And yeah, peace out, guys. And oh yeah, I appreciate y'all guys joining as well. Peace out.